You think boosting your super requires thousands in spare cash. That's not how it works. The government will add up to $1,000 a year directly into your super account, and you don't need to find a single extra dollar to qualify. There are two separate programs that most Australians approaching retirement have never come across. The first is the government co-contribution, which matches 50 cents for every dollar you put into super from your own after-tax income, up to $500 per year. The second is the low-income super tax offset, which automatically adds up to another $500 if your income is under the threshold. Together, that's $1,000 per year that you may be leaving behind. And both programs were built specifically for people who feel like the super contribution system has nothing to offer them. I used to think the same thing. Every piece of advice I came across was about salary sacrificing six figures or hitting contribution caps. And it all felt like a system designed for a completely different type of earner. Then I found these two programs, and it changed the way I looked at what was actually available. Today is the 30th of June. That date matters more than most people realize, because there is a second mistake that is quietly costing thousands of Australians tens of thousands in tax savings, and the window to fix it closes at midnight tonight. In this video, I'll walk you through exactly who qualifies for both programs, what to do before the deadline, and why so much of the super contribution advice out there is built around people who look nothing like the average Australian approaching retirement. If you've ever looked at your super balance and thought it was too late to do much, this video might change that. The co-contribution works like this. For every dollar you personally contribute to your super from your after-tax income, the ATO matches it with 50 cents. The maximum match is $500, and to get the full amount you need to contribute $1,000 of your own money. If your total income is under $43,445, you're eligible for the full co-contribution. No special paperwork, no complex setup. You make the contribution, you lodge your tax return, and the ATO deposits the money directly into your super account. The second program is the low-income super tax offset. When your total assessable income is under $37,000, the ATO takes 15% of the concessional contributions made on your behalf, including the super your employer puts in, and refunds that amount directly into your super. The maximum refund is $500. This one is fully automatic. You don't need to do anything except lodge your tax return. So between the two, you could be receiving $1,000 per year into your super without needing thousands in spare cash. Just $1,000 of your own money to unlock the co-contribution, and the low-income super tax offset arrives on its own. A concrete example shows what this looks like in practice. A 62-year-old works part-time and earns $35,000 a year. She transfers $1,000 from her savings to her super fund before the end of the financial year because her income is under $43,445. The ATO adds $500 as a co-contribution. Because her total income is also under $37,000, her low-income super tax offset of $500 is calculated automatically based on her employer contributions. Her super balance goes up by $2,000. Her out-of-pocket cost was $1,000. The government matched her, dollar for dollar. Now here is the trap, and it is the reason most people never see this money. The standard advice around super contributions is aimed at people with tens of thousands in spare income. It talks about maximizing salary sacrifice, topping up concessional caps, and tax strategies for higher earners. If you're on a modest income in your 50s or 60s, maybe working part-time or winding down gradually, you read that advice and assume it simply doesn't apply to you. You assume you are not the target. But these two programs were designed for exactly this stage of life. The co-contribution and the low-income super tax offset are both targeted at lower-income earners. The less you earn, the more benefit you receive. If your income is under $43,445, you are the intended recipient. I've watched people go years, assuming they weren't the type of person who could do anything meaningful with super contributions, not because they had done the research and found they didn't qualify, but because nobody told them to look. If you're in your 50s or 60s, earning a modest income from part-time work, and you have never made a personal after-tax contribution to your super, there is a real chance you have been leaving $500 to $1,000 a year on the table without realizing it. If this is the first time you're hearing this, hit subscribe. I post practical super strategies every week, built for real Australians, not hypothetical high earners, and we are only halfway through the mistakes most people make. If you earn more than the income thresholds we just covered, there's a different mistake that may be costing you far more. And the deadline to act on it is midnight tonight. Since 2018, Australians with a total super balance under $500,000 have been able to carry forward any unused portions of their concessional contribution cap from previous financial years. The concessional cap is the annual limit on contributions taxed at 15% inside super, which in 2025-26 is $30,000. If you didn't use the full $30,000 in a previous year, that unused amount doesn't disappear immediately. It rolls forward for up to 5 years. But after 5 years, it does disappear. And tonight, the unused amount from the 2021 financial year, the pandemic year, expires permanently. Take this scenario. A 60-year-old has $450,000 in super. Over several past financial years, she didn't come close to using her full concessional cap. She has $80,000 in unused carry-forward amounts still available. Combined with the current year's $30,000 cap, she can contribute up to $110,000 in concessional contributions today. At a 45% marginal tax rate, shifting that additional $80,000 into super at 15% instead of holding it outside and paying 45%, the tax saving is around $24,000. That is a one-time opportunity. After midnight tonight, the 2021 amount is gone permanently. This rule was introduced in 2018 to give people with interrupted work histories a genuine chance to catch up. Career breaks, part-time periods, reduced hours, all of those years where your contributions fell short can potentially be made up if your total super balance is under $500,000. The 2021 financial year had particularly low average contributions across the country. Many people who had the ability to use this window were simply unaware it existed. I nearly missed this particular window myself, not because I didn't know the rule, but because I was focused on the wrong part of the calculation. A client reminded me that the best strategy is the one you actually use before it expires, not the one you understand in theory. If you've had years where your super contributions came in under the annual cap, whether from part-time work, a career gap, or self-employment, it's worth logging into your ATO account tonight to check what's still available before midnight. But the picture gets more complicated from tomorrow. The cap increases that take effect on the 1st of July might actually make it better for some people to wait. And knowing which side of that line you're on matters quite a bit. From midnight tonight, the contribution rules change. The concessional cap, the non-concessional cap, and the bring forward threshold all increase. Whether you're better off acting before midnight or waiting until tomorrow depends on one number: your total super balance at the 30th of June, 2026. The concessional cap rises from $30,000 to $32,500 from the 1st of July. The non-concessional cap, which covers after tax contributions, rises from $120,000 to $130,000. And the bring forward rule, which lets you contribute Up to 3 years of non-concessional cap in a single year rises from $360,000 to $390,000. For most people, acting before midnight makes sense only if they have a specific carry-forward expiry tonight, like the 2021 amount we just discussed. That's a genuine deadline with real money attached to it. But if you don't have a carry-forward expiry today, the picture is different. If you plan to use the bring forward and make large after-tax contributions over 3 years, waiting until after the 1st of July allows you to contribute $390,000 instead of $360,000. That's $30,000 more working inside a tax-advantaged environment. Over 10 years at 7% average returns, that extra $30,000 compounds to roughly $59,000 at retirement. Not a reason to delay a decision you should be making today, but a reason to be precise about your timing. There's also a situation that catches some people off guard. If your total super balance at the 30th of June is between $1.9 million and $2.1 million, you may currently be ineligible to make non-concessional contributions at all. But from the 1st of July, the eligibility threshold rises to $2.1 million, which means waiting just 1 day could restore your ability to contribute after tax. That's a significant shift for anyone in that range. The variable that determines your path is straightforward. Under $500,000 with a carry-forward expiry, act before midnight. Near the $2 million mark, consider waiting until tomorrow. Somewhere in between, the right choice depends on your specific circumstances. But knowing all of this still doesn't help if there's a quieter barrier stopping you from acting in the first place. That's what we need to talk about next. The biggest barrier to accessing these programs isn't understanding the rules. Most people can follow the mechanism once someone explains it clearly. The real barrier is a quieter belief that super contribution strategies simply aren't for people like them. If you're in your mid-50s or early 60s and you've spent years feeling like super was a system designed for high-income earners and complex investment structures, that feeling is completely understandable. The media examples are usually about six-figure salary sacrifices or people with self-managed super funds. The terminology is dense. And when you look at your own situation, maybe part-time work, maybe a modest balance, maybe a few years of gaps in contributions, the whole conversation feels like it's happening in a different language. The shift that helps most people isn't a new piece of information. It's a reframe. Instead of thinking, I can't afford to contribute, start with a different question. Can I get free money from the government by making a small move? Those two questions lead to entirely different outcomes. The first closes the door before you've checked what's behind it. The co-contribution and the low-income super tax offset are not aspirational programs for people who have already built significant wealth. They were designed specifically for lower-income earners. The less you earn, the more benefit you receive. And the small move required, a $1,000 transfer before tonight, is genuinely achievable for many people who would otherwise write off the entire idea. I don't know every detail of your situation, and I'm not in a position to say exactly what the right move is for you. But I do know that ignoring free money because you feel like super strategies aren't meant for you is a mistake that compounds over time. A $1,000 contribution a year for 5 years, growing inside a low-tax super environment, adds up to more than $6,000 at a 7% return. That's real money that doesn't require a complex strategy to access. Here's one concrete action you can take right now. Log into MyGov. Check your most recent tax return to see what you earned last financial year. If it was under $43,445, make a $1,000 transfer to your super fund today. That's it. You don't need to figure out the entire retirement picture tonight. The next section covers the exact steps and just as importantly, the warning you need to hear before you touch your non-concessional contributions. If you're eligible and you want to act before midnight, here is exactly how to do it. The first step is to check your eligibility. Log into MyGov and navigate to the ATO Services section. Under Super, you can view your co-contribution estimate and confirm your total super balance as at the 30th of June 2025. If your balance is under $500,000, you may have unused concessional carry-forward amounts available. Check your concessional contribution history, going back 5 years, to see what is still usable before midnight tonight. The second step is to make the contribution. For the co-contribution, you need to make a personal after-tax contribution to your super fund via a direct bank transfer. A minimum of $1,000 is required to receive the full $500 match. Make sure the payment is received by your fund before midnight tonight, not just sent from your bank. Processing times vary between funds, so check with your fund about their cut-off time for same-day deposits. For carry-forward concessional contributions, you'll need to submit a notice of intent to claim a deduction to your super fund. This document tells the ATO you want your personal contribution treated as a concessional contribution, taxed at 15% inside super. That form must be submitted to and accepted by your fund before you lodge your next tax return. The low-income super tax offset requires no action from you. The ATO calculates it automatically after you lodge your tax return, based on your income and your employer's contributions from the year. Now the warning. This is the part that trips up people who act without checking one detail first. If your total super balance is close to or above the non-concessional contribution thresholds, and you contribute more than $120,000 in after-tax contributions in a single financial year, you risk triggering the bring forward rule unintentionally or exceeding it if you have already used it in a previous year. The ATO will assess the overage, and excess contributions may be taxed at your marginal rate. I've seen this happen to people who did the research but didn't check their own contribution history before acting. It is a costly and stressful outcome. Before you make any after-tax contribution today, log into MyGov and check your non-concessional contributions history for the past 3 years. Confirm you haven't already triggered the bring forward in a previous year. If this video helped you act today or helped you avoid a mistake, hit subscribe. I post a new super strategy every week, built for real Australians. We've covered a lot of ground today, but the core of it is straightforward. The first mistake most Australians make is overlooking 2 government programs that together can add $1,000 a year into your super. The co-contribution and the low-income super tax offset exist specifically for lower-income earners. If you earn under $43,445 and you've never made a personal after-tax contribution to your super, you may be leaving that money behind every single year. The second mistake is missing the carry-forward window that closes at midnight tonight. The 2021 financial year's unused concessional cap disappears permanently after today. If your total super balance is under $500,000 and you've had years where your contributions fell short, the opportunity to use that carry forward and save tens of thousands in tax may still be open right now. And from tomorrow, the contribution caps go up across the board. Whether that changes your strategy depends on your balance and your timeline. You don't need to be a financial planning expert to take advantage of any of this. One small move tonight is all it takes. If you acted today because of this video, leave a comment below with the word done. I'd genuinely like to hear about it. And as always, this is Bob, helping you retire with confidence on your terms.